It's really hard to put a financial, price tag on it, but I have to say, like, I don't think I would be where I am now if I didn't go through the BS that I went through with that property.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you are enjoying this show and get some great value for your investing needs, let us hear about it. Leave us that rating and review. It helps us, but it also helps other investors find this show. And listen, if you haven't done so already, make sure you hit that follow or subscribe button so you don't miss an episode. We got a great show today. We're going to be talking to Denis Shapiro. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the Mastermind button today. Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you are enjoying this show and get some great value for your investing needs, let us hear about it. Leave us that rating and review. It helps us, but it also helps other investors find this show. And listen, if you haven't done so already, make sure you hit that follow or subscribe button so you don't miss an episode. We got a great show today. We're going to be talking to Denis Shapiro.
John, thank you so much for having me. Huge fan. So a cool honor to be here.
Awesome, man. I appreciate you having time to come and join us today. I went over your bio at a very high level, a lot of interesting things there. Why don't you take 2 minutes and give us a little bit more context?
Yeah, I find this question always funny to try to summarize your whole life in like 30 seconds to 2 minutes.
Right.
Which points you leave out, which points you keep in. So the gist of it is I started investing in traditional stocks since I was like 14 years old. Went to college, wanted to be the next Warren Buffett, but went to college in 2005. By the time I was a junior, like the global financial crisis was all around us. I was actually in school in New York City. So it was interesting. I was like 20 blocks away from people like committing suicide and all this stuff. And it was like a completely different world. But I ended up pivoting, went to graduate school, got recruited by the government. And then when I started working for the government, I realized that they were also my business partner with how much taxes they were taking out. And that's kind of when I went down the real estate rabbit hole, because when I came home, I remember from like my first paycheck, I was like, well, how do I pay less taxes? And it's the semi-illegal first round of suggestions. By the time you get to the second and third page, it's all about, real estate, bigger pockets, the whole 9 yards. So then I proceeded to do this most stupid thing that anybody could ever do is I called my oldest brother and was like, well, you have a couple of properties. Like, do you want to sell anything? I just need a tax write-off. And he's like, yeah, sure. Here, take this one. And it was his biggest problem. And I probably
What a
overpaid.
great, what a
Yeah.
great big brother.
Yeah, to be fair, now in hindsight, it's probably my own ignorance and not understanding what I understand now. And I don't think he understands what I understand now. So it's a little bit different. I think it was there was a period of time that I did resent him for that acquisition. But at the same time, I got to, roll up my sleeves, run a low income family housing, and got to be the general manager, the property manager, the construction manager, the whole 9 yards, the leasing agent, the guy that gets the cop calls, and the whole 9 yards. And I realized quickly that I didn't want to scale that side of things. At the same time, my career was actually doing pretty well, and I was starting to get some more raises, so I had more capital. So I knew I didn't really want to be too active at that point in my life, and my career was going well. So I started looking into more passive investing, and that's kind of how I got in. That was about 2012. I stumbled onto I stumbled onto what a private placement memorandum was. Went down that rabbit hole. Went from note fund investing. Then I kind of got into the what I call the gateway drug of commercial real estate. It was like multifamily. Got into my first multifamily deal. Started really drinking the Kool-Aid on being an LP investor. I thought it was the coolest thing ever to own, 1%, 2% of these large apartment buildings. At that same time, my career was still doing pretty well. Then I met two other individuals who were kind of on a similar path to me, and we got together and we started doing a whole bunch of LP deals. And that was the investment club that you mentioned. That really helped things out because on my own, I was doing, I was on track to probably do a deal a year. With the investment club, we ended up doing 10, 13 deals in that first year of the club.
Wow.
And that gave me so much data between which operators were doing really well, and more importantly, what characteristics ended up producing the best results in a syndication, right? Like one thing I started paying attention was, the unit composition, whether it's 1 bedrooms, 2 bedrooms, 3 bedrooms. We find that the deals that we invested in that had overwhelming amount of 1 bedrooms always had issues with vacancy. And then we started piecing together which markets we liked, which markets we didn't like. And then from that investment club, I ended up starting SIH Capital Group. We were focused mainly on LP deals right until COVID. And then once COVID happened, we started switching over. First, we did a couple of joint ventures, and then we got more and more into the operational side. And then we ended up having this niche of affordable housing. And that's where we are today, a couple of years later. But it wasn't like a coaching, it wasn't like a boot camp where we went in and, a week later we're raising
Right.
capital for $20 million deals. It was a very, very slow process of, getting into alternative assets, seeing which alternative asset fields that we really liked, narrowing that down, and then figuring out, then getting into the JV world where we had a seat at the table, but we weren't the lead operators. And then slowly, slowly, it ended up being more and more on the operational side of things.
Yeah, man. Dennis, I love your story, man. You talked about your background and experience, and it took time to build, right? So you started off, trying to figure out how to pay less taxes. You talked about the government being your unintended business partner with their cut of the proceeds there, which I think everybody can relate to. From there, you started doing your research, realized real estate was your best path to reduce your tax liability out of the legal options. So once you went there, you talked to your brother who had some properties. He gave you one of his problem children. You took that over. You were the asset manager, the general manager, the PM. You did everything you could on that deal. But also you learned that, hey, I'd rather be more passive. And we're going to come back there in a second. So from there, you looked for more passive opportunities and ended up being able to scale that into a larger portfolio, partner with these other guys, and ultimately end up launching SIH Capital Group. Let's go back to that time when you were managing that problem asset. I think a lot of people, when they think about what a real estate investor is, it's either being a landlord or a flipper. That's the vision most people have, or the knowledge that they have of being a real estate investor. You mentioned that you had your day job and you were doing well and getting promoted, but it got to a point where it was just too much. Take us back there, because if you knew about syndications, if you knew about different investment strategies, would you do it all the same, or would you try a different approach, particularly if, you had someone coming to you asking you, hey, what do you think I should do? If you go back there, what advice would you give yourself, in the midst of that situation?
That's such a great question. I think financially, I would never do it again because financially, I could have literally took all my money and just threw it in the air and got the same results for, a decade, a roaring period where a decade saw a 20% annual growth. So from a financial perspective, it was not a good investment. But then it becomes the question, well, what value do you put on education? And these days, to me, it's 10x what it is because it doesn't really matter that I didn't make a 20% return at that time period. It matters all the different lessons that I learned. Like number one lessons, everything was on my shoulders. That was and compared to today where I have strategic partnerships in affordable housing and then we have a hospitality division, it's night and day. And I think that's the number one thing that looking back at it, I'm like, wow, I really didn't understand how to harness partnerships, how to actually leverage them. And so looking back at it, it's the lessons that I learned. It's really hard to put a financial, price tag on it. But I have to say, like, I don't think I would be where I am now if I didn't go through the BS that I went through with that property.
Yeah, I'm hearing you say that you kind of you wore all the hats. You were really a solopreneur on that project. And your biggest takeaway was you didn't have to have it all on your shoulders. You could have leveraged the expertise of other people, whether it be a more experienced property manager, partners, other folks, so that you kind of spread out that knowledge, spread out that expertise, and get more help, as opposed to you being a new investor, not even having the experience and trying to figure all this out by yourself. Not to mention you got a busy day job as well. So that's really a big lesson there. And I think it's important for people to understand, because if you were to sit back and you really think about this and say, hey, we got two business plans. Business plan A, we're going to take this person who has no experience and we're going to make them do everything by themselves. All right. Plan B is we're going to put together a team of folks who have different levels of experience and knowledge and different expertise. They're going to come together and work on this project. No one in their right mind would pick plan A. But every investor, or not every, but so many people go out and do that when plan A is them. They go out and try to do it all by themselves, even though they have no experience, no track record. It's all their money. So they're putting everything at risk. And by the way, they probably don't love this space. So this is something they're trying to do to make a little extra money on the side, but they got a day job. They maybe have children. They have other responsibilities. And if you really break it down, it's asinine that you would take all your money, take on this business venture where you have no experience or knowledge, and you're going to go out there from reading a couple books and try to go and invest, 5 figures or 6 figures of your own money and pray it goes well. Instead of partnering up with more experienced folks, people who can at least take on different aspects of this deal, spread the wealth. Everybody's invested into the opportunity, and you can leverage the time and the expertise of these other people. But when you break it down like that, it seems pretty obvious, but most people never think about it until it's too late. So I love the fact that you talked about kind of your lesson learned there. Let's fast forward, because you said something that was really interesting, right? You said on your own, you were doing kind of one deal a year as a passive investor. But when you had the investment club, you were able to do about 10 to 13 deals in that first year. And you were able to really learn from looking at the portfolio to say, hey, here's the trends I'm seeing. These properties with a lot of one bedrooms don't seem to be doing as well or have higher vacancy. What are some of the other lessons learned from being able to build a portfolio and really evaluating kind of the trends that you see throughout that portfolio?
So yeah, there was definitely a couple of big takeaways I had. One of them was actually leveraging the insights of my investment club partners. So one of the things, we had like a Slack channel, and every single investment that we had, we actually posted in, and we actually had to, before okaying the deal, we all had to get on a call and actually talk pros and cons. And that was such a valuable experience, where the two other individuals that I had, they're not really commercial real estate guys. One of them is like a crypto guy. The other guy was a big tech guy. To get their viewpoints on how they look at commercial real estate, I think really, really like fast tracked my career as a commercial real estate operator, because I was getting incredibly good feedback from two really high level professionals. That I think that feedback has stayed with me for the next 6 7 years as the investment club. So one of the byproducts, that it was just getting used to working with really, really good people. Like when I worked for the government, the government is full of the 80/20 rule. It was, I worked in an office of 35 people, 6 people pulled their weight, and then 29 people just skated by, and there was fear of repercussions for like reprimanding them, or the union would get involved. And so you strip out the fact that maybe I enjoyed working with 10% of the people. However, with this investment club, like this was a voluntary club, and we all got together to actually work together, and that was my first real like experience where it's like, holy crap, it's my idea plus their ideas now is 10xing what decisions we're making. So just learning how to actually work with with a certain type of entrepreneurial mindset and seeing the results from that, I think that was one of the most aha moments in investment club. And then we ended up partnering with other people, affordable housing and hospitality, and all of that kind of just applied over and over again. So that experience of just working with people that you actually respect, because so many people are saying, well, I can't partner with someone. Well, you can't partner with someone because you can't respect someone else's viewpoint, skill set, all of that stuff. So just that investment club, that first thing was actually teaching me how to value other really super competent people. And it can't just always be my voice. It can't always just be the way I want to do it. And that was a huge, huge aha moment because my previous career, a whole decade of not doing that was it. So it was a huge 180 shift. But I know that's not really the question you kind of were asking. You were like, besides affordable housing. So the other things that we did pick up from, not affordable housing, from the investment club, the other things that we picked up that were major was the importance of property management. That was by far the number one excuse used by syndicators when the deal went bad. Well, it's this third party property management company, it's this third party, and this is why it happened, or whatever, is blah, blah, blah. So we started really honing in on syndicators that either had their own management company or had a really, really long track record of working with a very, very specific third-party property management company. So, there's nothing inherently wrong with a third-party property management company. However, it's also the number one excuse used when a syndication is going bad. So we started really picking up on that trend. So the property management company was huge. The second big part was actually figuring out, like, understanding the asset management team that specific syndicator has. Like, what I think we started realizing was how much marketing and how much that the lead operator might be the world's best marketer, but has nothing to do with the operational side. So we started understanding that because we were at first almost like in awe with some of these operators, like, oh my God, I heard him on a podcast, or I saw him at a conference. He must really know what he's doing. So I feel too embarrassed to ask them, well, what does your organizational structure look like? And what we started realizing is that this stuff is really a business, and you need to understand what that blueprint of that specific operator's business is. Does he have one asset manager per region? Does he have just one asset manager in his whole team? Like, well, how many partners are equity partners versus salaried partners? How big of a staff? Like, what happens if he doesn't do an acquisition for a year or two? And then figuring out where their income comes in. So we started learning the business side of the syndication space, where initially it was just like, oh my God, it's so cool to own 1% of an apartment building. Then with the investment club, after a few months and years, we started realizing, well, it's not about 1% of that apartment building, it's 1% of that specific business. And we need to really figure out how that business is run. So we started having all these different realizations. And that's kind of what started moving us from the LP side of things, saying, like, not to badmouth any operators, but like, some of these organizational structures are pretty shallow and hollow. They're not really, they don't have a good foundation. And then we started realizing, well, we have certain skill sets we can actually help out, whatever it is. And that's how we kind of started moving on to the joint venture side of things. And then we stayed there for a couple of years before we realized a few things. And then we more or less started shifting over to more of the operational side.
No, I love that. I want to drill a little bit deeper here because I think you've got some great intel and some great knowledge from your experience. What's one thing all great operators have in common?
I would say a certain culture, like a certain accountability culture. Fortunately and unfortunately, I've invested in Ponzi schemes,
Oh,
or deals that have gone Chapter 11. Now, what I realized during that process is, like, hey, how well did I know the person on top, or did I just talk to an investor relation person? And what you start realizing, and there's nothing wrong with investor relations because I do my investor relations for SIH Capital Group, but if you speak to an investor relations person who's not an equity owner, their job qualifications is basically to be a yes man, right? They are a salesperson. They're supposed to sell you that specific investment or whatever it is. And if you call them, they're going to be super nice. They're going to be super likable. However, if their boss and their boss is I don't want to use the wrong words, but is a douchebag who's, has three wives, spending shitload of money on alimony, hardly sees their kids and has no ethics in their body, like, you're never gonna know that. So what I started realizing is, like, how important that culture is in the actual organization. Like, have you talked to the person in top? Like, do you know how many kids they have? Do you know, their spending habits? I've had an investor reach out to me and is like, can I have your personal financial statement before investing with you? And, like, at first I was like, well, that's weird. I've done 20 LP deals. I've never asked for it. And then, like, the more I thought of it, I was like, that's actually pretty brilliant. Like, like she's gonna spend $100,000 with me. Like for me to give her my statement to show that what I'm capital like liquidity capable and everything like that. It also shows how many cars I have and it shows, what my house is worth, and she could look at all of that stuff. And she was a local investor as well. So she knew what area I was from and all of that stuff. But it's stuff like that that really doesn't show up on any social media post. It doesn't show up anything. But like understanding the actual culture of that organization and how accountable are they and how quick. And I'll give you two examples. With this recent 6 months of, and not 6 months, last year and a half, since the rates start coming up, right? There's been a lot of carnage in the commercial real estate
Yeah.
world. And as an LP, I mean, as the LP side of me, I still talk to a lot of LP investors. And sometimes it has nothing to do with our own deals. We just talk because we have a big network of LP investors. And from some of them, I've learned that some operators, they've done their capital calls, and, unfortunate as it is, but I've seen one operator give up their entire GP promote on their next deal. They said, "Hey guys, we are so sorry that this is happening. We screwed up on the interest rate. We picked the loan, but this is a great asset. We're going to see it through. We're not going to lose it. But on our very, very next deal, the whole GP promote is going to you guys to make, hopefully you get more returns on that deal to make up for it." Like I seen that, and I was like, wow, that is cool. That is something that I could model out of my own company. Like if a deal goes bad, that's how you handle it. Then I've seen it, I've talked to other LP investors who were part of, 5 or 6 foreclosures. And I was like, well, is the operator doing anything? Are they offering any concessions on the next deal? Are they changing even the asset management? They're like, nope. They said that this was an investment and you know what risks you were taking. So I think that's your two sides of things. You want to know which operator you're getting in bed with. Are you getting in bed with the operator who's going to do whatever it takes in their human power? And sometimes, they exhaust all options and the deal just goes bad and you just have to live with it. But you're okay with that versus the operator who literally, like the first sign of like it getting a little hard, he can't handle it, whatever it is, blah, blah, blah. Oh, too bad. You took the risk. My private placement memorandum protects me. You can't do anything about it. Good luck. So that's the type of stuff that no one screams about in the returns. They want to post, the fact that in 2018 to 21, they've done 4 or 5 deals and they have 20-30% IRRs. Well, how are you handling the deals that aren't the 20-30% IRRs? Because that's what's really going to make the returns for the next 3 to 4 years.
Dennis, I love that perspective, and I think there's a ton of value you just gave our listeners. You talked about, kind of better questions to ask and what to look for. One of your lessons learned is really it comes down to understand. My summary is understanding the culture and character of both the organization, but also the principles. When things get tough, how do they operate? Are they the group that's going to point to the PPM and said, "Hey, we told you they were risk. Sucks for you, too bad," and keep it moving? Or are they the kind of people who want to do everything possible to make their investors whole? The difference here is one of those people are focused on the long term. They're looking at investor retention. They're looking at trying to create long-term wealth in partners. The other is simply trying to get rich as quickly as they can. You want to make sure you understand who you're dealing with, because to your point, anybody can pull up a track record and we can show from 2000, 16, 17, 18 to 2021, we had great returns. I mean, we got it as well, right? We've got a 19%, IRR return over all the deals we've done. It's great. That is not indicative of future performance. That's why every single investment statement has past performance is not an indicator of future performance, right? Because those dynamics are simply different. And these are the important questions to ask. Don't just fall in love with someone because you heard them on a podcast, even if it's me. Figure out who they are at the core. Find out who the person is. What's their character? How are they as people? So figure out those things and use that to understand the organization. How do they approach the organization? And I don't think there's a singular way of structuring your organization. I think it comes down to, what your priorities are, your vision, and what matches the vision based on where you're at today. But I do think the culture of how you make decisions is critical and important. Who you surround yourself with, how you approach the business, how you take care of your investors. And quite frankly, if I could give one little thing, I always like to ask people about a deal that didn't pencil out. So you talked about the importance of property management, and property management is key. It can make or break your deal. However, if I'm talking to a sponsor and I'm trying to figure out, hey, tell me about a deal that didn't work out, and all they do is blame a bad PM, that's a pretty big red flag for me. Not because they're blaming the PM, it's that they're not taking that accountability and ownership for hiring the PM, for not doing something about it sooner. And that's something we've always had to look at our own business and say, at the end of the day, no one wants to hear the excuse, right? Figure it out. And your job as an operator is to navigate whatever, muddy waters you're facing to take care of your investors. And it doesn't guarantee you're going to succeed, but you should at least have that mentality to say, all right, I need to solve this problem. And if this is the problem, let's fix it. If is it the PM, or is it a process, or is it a person? Is it the company? Is it expectations? Did you mess up, with your initial analysis and you just simply used the wrong numbers, right? Or you just didn't understand the market as well. So there's a lot that goes in there. But to your point, if people understand the culture and the character of the organizations and people they're working with, they're going to be in a much better position. So I appreciate you sharing that. Anything else at this point before we switch gears?
No, I think you summarized it really, really well. I would also say, a lot of it is just people trying to take shortcuts, especially
Yeah.
investors. The only way you get to really know the culture and everything like that is time. And it's just about really taking your time and getting to know an operator. And sometimes you will know really, really quick if it's an operator who's, it's a one phone call guy and oh, you didn't invest with me. I'm not taking a second phone call type of guy.
Yeah.
Or are you the guy? And I always tell this story. When I was an LP, I had someone I met, also big social media presence. I got on a phone call. I thought it was a good thing. He sent me a deal in the Midwest. I think it was in Ohio. And I literally spent an hour going through the deck and sending him a list of questions. And it was like 12 questions I had. And I was actually really proud of these questions. And I sent it to him and it was just ghost. There was not even a response. There wasn't even like, hey, sorry, we're in the middle of a raise. These are really good questions. I will get back to you and we'll continue building that relationship. It was just nothing. And it's so funny because now I'm going through a raise right now. And I had as an investor, and she sent me like 10 really good questions. And I'm looking at my inbox and I'm like, no, no, like she's getting an answer like today. And it spent me like an hour. And like sometimes that's a lot for one email when you're in the middle of a raise. But I was like, I'm not gonna be that guy where you're gonna tell that story. So always something like that. Like just test the operator just a little bit. Like
Yeah.
don't just be like, hey, yeah, this deal looks good. I'm in for 50. No, like actually, unless you've done 100 deals with them, then they've been proven tested, the whole 9 yards. But it's like, it just put a little bit of effort to give them a test, like something you would almost do for your kids. You know what I mean? Like, hey, don't play the victim card. Like, show me some accountability. This. And
Yeah.
can they actually respond to that? Because if they're not going to respond before you wire that money, they will never respond after you wire
Yeah.
that money.
You know what? That's one of those great points because you got to trust who they are, right? They're going to show you who they are. So trust them. Trust them when they show you. If you ask questions, do they respond? Do they not respond? Everyone gets busy. That happens. That's part of it. But again, if that's the norm, or if they're inaccessible, that's something else that you want to pay attention to. It's funny you mentioned the 12 questions. I had an investor once send me about 12 questions, very well thought out questions. I took the time to answer every single one of them. And I mean, one of them was such an intelligent question. I had never even thought of it. And I had to sit there and talk to the partners like, yeah, like, so we had to do research. We had to come back with data points, right? And the question, this was around the time of the election. And the question was, well, hey, and this was a deal in Texas, and they were asking about border control. And they're like, well, hey, if they really get tight on the borders, a lot of the population growth in this market is driven by immigration. Like, are you concerned that the population growth will decline, and will that impact your business plan? I'm like, damn, that's a brilliant question, right? So I had to go and do research, like how much of the population growth is driven by. So I mean, I had to spend an hour like really answering that one question out of 12. But my point is, we answer all these questions, and this person just came back with 6 more questions. And part of I said, well, hey, I'd love to talk through this, right? Because I had never talked to this person. They were on my list. I think we exchanged some emails. I'm like, hey, I have no problem answering your questions, but let's also talk live because I'd rather like let's just talk so I can hear it, answer it, go through it. And so we answered the other 6 questions, and then I never heard from that person again. And it's like on the same note, like, hey, this is not a test, right? It's the point is to try to be partners. And that's
Yeah.
a two-way dialogue, right? I'm evaluating you, you're evaluating me. Let's see if it's a fit. But let's work through that if you want to work together, and it's okay if it's not a fit. Like that's perfectly fine too. But make sure you're not out there just quizzing people. And I remember one of the guys I know, and I've had him on the show. He had a list of 101 questions to ask operators, and I was like, yeah, but if you ask 101 questions, I promise you, they'll just remove you off the list. Like, so anyway, great stuff, great questions. But again, the point is not to drill someone and see if they could pass the Harvard Law Review. Is really just to make sure these people are knowledgeable, trustworthy enough, and have the right character mentality to help navigate the investment opportunity. So great points there. Hey, we're running short on time, but I do want to make sure we understand like your focus now is in affordable housing. What's one of the biggest misconceptions people have about affordable housing and particularly investing in affordable housing?
Yeah, they think, like if they remember like the HBO show The Wire, they
Yeah.
think that's affordable housing. And it's not. Like the way I try to describe it is like if you have a raw piece of land, the cost to build that raw piece of land up to a beautiful Class A project and an affordable project is surprisingly similar because you have to lay the foundation, the roof, the windows, the whole 9 yards. You're going to change the finishing touches, you're going to change floor plans, all of that stuff. But so the truth is they would never in their right mind, the developer in their right mind will never ever build affordable just for the sake of building affordable out of the goodness of their own heart. So the government subsidizes a lot of these development costs through these LIHTC credits. Now that's where we come in. So what happens is the developer comes in, they build this beautiful property. Usually sometimes it's brand new or at least within a 30-year time period, these things were fully renovated. And what ends up happening is there's these two 15-year LIHTC restriction periods. Now, the first 15-year period, it's very common for the developers to hold on to them. They have a lot of incentive to do so. The second 15-year period, all the incentives phase out. However, they still have to keep it affordable. And a lot of times the developers will sell in that second 15-year period. That's where we come in. We buy it. We know our exit because our exit is when the compliance period phases out. We know we have built-in appreciation because every year you get closer to that compliance period ending out, you actually get in built-in appreciation for the actual overall property. Like your cap rate actually starts coming down a little bit. So it's a very interesting business. It's the only one I always say in commercial real estate that actually has a barrier of entry. Not everybody can get in. You usually need to be approved by the state that provided the financing to actually approve you to take on that affordable housing because the last thing they want you to do is to buy 100 units of affordable housing and then you run into the ground and the state loses 100 affordable housing because there's such a shortage, such a demand everywhere. So that's high level. But what's surprising, a lot of people think is the returns are anything different. Most of the time, we underwrite the deal similar to any value add deal you'll see out there. So it's a 13 to 15% IRR returns. But the cool thing is, it's never a business plan. It's never a business plan where you're going to go in and say, well, I'm going to change out the floor, put a nice kitchen in, a bathroom, and we're going to charge $400 or $500 a month. No, because you're capped. You can only charge what you can charge. However, what we find out is that these developers, their capital cost is so low, they go years sometimes without putting in the rent increases. So sometimes, we get a rent roll and they're 2020 rent numbers and the HUD approved rents are 40% higher because of inflation every single year that got factored in. So sometimes we take over and we just file the rent increases. And those rent increases sometimes are paid by the state, sometimes by the tenant, the whole 9 yards. So we have usually very little to do with the revenue side in terms of, CapEx, all of that stuff. We're really focused on bringing down those expenses. It's not unusual to see 90. I think our latest acquisition right now, it's 98% operating expenses. We're underwriting just to bring it down into the 60s. So it's a very different business plan. It has a huge moat, and we really love the space going forward.
Wow, lots of information there. I appreciate you sharing that. So, a couple things that stood out to me is one, the business plan is just a little different. You've got those two 15-year periods. That first 15 years is almost a lockout for that developer. So, typically they're going to stay on and hold it. But that second 15-year period, that's when sometimes they will sell it, and then those tax credits kind of expire, those restrictions expire, and that's when you can either take it to market or do something else with the asset. And you mentioned that the business plan is less about that traditional value add where you're going to come in and renovate everything. It's more about operations, being able to take a look at the numbers, figure out where those market rents are, where those maximum allowable rents are, and understand what you can do to push those rents and drive it more efficiently. Particularly if you're saying, some of those properties are at 98% expense ratios, which is just insane. So being able to buy a property like that, get those expenses back in line where they should be, that's a great opportunity to business plan. For folks who do want to learn more, they can check out your website, SIHcapitalgroup.com. We'll make sure we link to that in our show notes. Right now, we're going to transition to our round of insights. Are you ready?
Let's do it.
Give me a failure or an apparent failure that set you up for later success.
First Ponzi scheme that I ever invested in.
Oh man, terrible.
Should I get into it or it's just quick?
I want to hear the quick story, yes.
So first Ponzi scheme, again, this is all culture.
The fact that you say first though is almost like, man, that's hurt me. It implies that you've been in multiple Ponzi schemes, so that's terrible.
Yeah, well, two Ponzi schemes, but one other deal that went Chapter 11, and part of that was a huge reason why we went from LP to GP. But so the first one we ever did, they advertised guaranteed returns, which was a big red flag. They advertised outside of, and this is also a really good lesson here for investors, is I met someone at a local meetup who was a wealth advisor for a very famous Princeton financial advisement thing. And I put a little stock in that and credibility. And at that point, I really didn't know anything. This was almost a decade ago. And we had a couple of lunches, and I asked him, well, what is the number one investment does your firm, what your members have, your clients? And he mentioned this specific company. So that put it on my radar. But then there was all these red flags where they advertised on the radio, they advertised everywhere. They had billboards and everything was guaranteed, blah, blah, blah. And they were also local. I'm in central New Jersey, they're in North Jersey, so I could go and see their office, and they were just moving into a brand new headquarters. And at the end of the day, I would not have invested in them. However, my investment club got a certain terms on the fund where they gave us equivalent of what a $500,000 investor would give you, the returns for whatever we put in. And we put in a nominal amount at that point. It was only $25,000. So we got blinded by the terms, and we let the terms overshadow the plethora of red flags that were part of this deal. But it always, now I go back, I'm like, well, am I talking to investor relations, or am I talking to the guy who's running the ship and all of that stuff? So a lot of my lessons today, and the importance of actually investing in relationships, and the returns come after the relationships, all of that stuff I've learned was directly as a byproduct of that spectacular deal.
I appreciate you sharing that. Lots of lessons that our listeners can take. All right, we're going to get back to the round of insights. All right, give me the digital or mobile resource you recommend most.
I would say Asana has been that for us. Just in terms of managing, we have a hospitality division and we have an affordable housing division. So just keep myself on track. There's another one that I actually invested in. It's called Noplex, and it's kind of an Asana with AI built into it. It's actually built for people with ADHD. So that's something that I've been kind of transitioning to. So those are the two that I think provide the most value for me.
Give me the book you've recommended or gifted the most in the last year.
So this one is selfish plug. The book I wrote during COVID, the Alternative Investment Almanac, Expert Insights in Building Personal Wealth in Non-Traditional Ways. I usually gift that during the Christmas time. I ended up interviewing about 30 people for that book, and they participated in the Q&As, and it was a great primer of all alternative assets, from multifamily to mobile home parks to self-storage. So I'll plug that book in.
Give me a daily habit that helps you stay focused on your goals.
Working out. Like I got to the point when I was working for the government and doing the real estate business that my health and my priorities really were out of whack, out of balance. 2024, since the start of the year, I joined CrossFit, which I really love, and just almost 5, 6 days a week of actually exercising. I think that's actually taken me to a different level.
All right, give me your number one insight for vetting investment opportunities.
So number one insight is take an Excel sheet, rate 1 to 10 on your relationship and 1 to 10 on reputation, and just write down all the operators that you have right now that you're working with, and then put in any new one. And you'll be surprised how little you rank on the relationship side of it, where you're basically just investing purely on reputation. So my one insight is try to get your relationship number higher.
Love it. All right, let's lighten the mood. You are based out in New Jersey. Give me your favorite place to grab a bite to eat.
So I live only 25 minutes away from the Jersey Shore. So there's a place, Marina Grill is one of my favorite places just because it sits on a marina. Like when the weather is right, it's just a great place to go and check out a sunset.
I love it. Sounds like a great place. Listen, Dennis, you gave us a lot of great information. I really appreciate hearing your story coming from working with the government, transitioning to real estate with that deal from your brother, eventually transitioning to being more of a passive investor, launch your own investment club, and then eventually launching your SIH Capital Group. The lessons learned, how to vet opportunities, the trends you saw across the different deals you were invested in, and also what it takes to vet deals, vet operators, to not get so sucked into the flashy marketing, but to really focus on the culture and the character of the organization and the principles. Again, for folks who want to learn more about you and your firm, they can check out sihcapitalgroup.com. Dennis, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.